Hello, my friends. Hello, everybody. I know some of you have been waiting for a wee while for some AMC technical analysis, so hit like if you're holding AMC. I'm holding AMC, but I've already hit like, so I'll not hit it twice. I hope you're all doing very, 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 very well. Good to see you out there in the chat. We've got lots of people out here that are good friends of all of ours in the community. Anyway, here we have the charts. It's funny to be on somebody else's chart for once. This is Jamie's chart here. So he's obviously got TA on here, which is not my own. How wonderful is that? That gives me a chance to kind of destroy his chart when he's not looking. Don't tell anybody, and don't tell anyone. Just kidding. So what are these lines here? They're just sort of horizontal support and resistance lines. Tell you what, I'm going to do the. I'm going to do this. I'm going to hit the destroy button. Oh my goodness, just destroyed everything. So couple of little things, I suppose. Since this isn't my own chart, then I can familiarize myself with it quite quickly. Obviously, we've got the MACD down the bottom of this here. That's the moving average convergence divergence. And we have the RSI here. That's my own RSI. Recognize that bad boy, absolutely. When I use the MACD, I tend to not really use the old lines on it, the crossing over lines there so much, but there we go. Oh, and of course there's indicators there as well. Thanks, Jamie. Show me how to add my own indicators to the chart. Well, you know, you'd think I'd have enough wrinkles on the old cerebral cortex to have known that myself. Hey. Well, great. Nice one. Let me just stick on the DMI here as well. And maybe I'll adjust this. You know, people who watch my channel know that I'm not a massive fan of the MACD signal line overall here. And I prefer to just simply use this to look out for divergence. And I do that using the histogram, which means I don't need these two lines on here. All right. However, I'm going to leave it on here to not mess with Jimmy's chart too much. I will point out, pardon? Fuck it up if you want, says Jimmy. There we go. So, Divide and Conquer says, who was this? It was Ultimate Strife. Yes, Ultimate Strife. Let's bring some Ultimate Strife by dividing and conquering. By the way, divide and conquer is one of those phrases that comes from, you know, that body of knowledge that we have from war, okay, from back in the day, and it's maybe would actually serve you quite well out there if you haven't already to read the art of war and to understand its concepts and apply them to trading. There's many good analogies to be used here in trading. For instance, you know, pick your battleground, make the enemy fight you where you want to fight them, and in that sense, what's your best entry, etc., going to be on this bad one? Is this the battleground of our choosing? And looking at the MACD just here and seeing that it's coming in for the potential for a cross, you would be, you know, inclined to say perhaps not, now that we've had a big rise up in the prices. Okay, and that we haven't taken out this previous area just here. That's messed up this moving average convergence divergence ever so slightly for us. And I want to remove this. I'm going to remove it because I don't want to be given overall what could be a false signal in terms of a cross just here, for instance. Right now, what does he mean by that, Rocky? Well, personally, I wouldn't be wanting to go short on AMC anyway. We all know this with the whole ape community stuff anyway right now. But if you were looking to try and do that, you know, if that was your, like, okay, like, right, know your enemy. Again, another thing from the old art of war, know your enemy. What is the enemy thinking here with regards to shorting this, and what would be the best place to do it? And you can see there where I've left the mouse on the screen, providing that crosshair serrated white line going horizontal across the screen there, that I'm showing us an area of course, support on the prices, which is represented with a few different touches of that line. Just looking at it real easy here, you can see, of course, we came in and touched it very recently just there, and of course we touched it here and we touched it back over here again. I then would like to say to people that, you know, you're not really looking at this with any degree of negativity until the prices have dropped down below that 825 area. People are asking me, therefore, what's your best buy price on AMC? And the best buy price comes in around about $9 currently. Now, that, of course, is not exactly, you know, within spitting distance when we see the prices are at $9.95. You'd be looking at a more than 10% drop off to get down there. Well, actually, to be honest with you, my price point was more closer to $9.05 probably than $9 itself. So So yeah, it wouldn't necessarily be that full 10% you'd be looking for to drop off, but that would be where you'd be looking for. What's the reasoning for that? And is it visible here in the 24-hour time frame? And it's not really properly visible, to be honest with you. There's a few things though that I would like to point out. This is actually the weekly time frame, sorry. A few things on this weekly time frame that I would like to point out. Right, okay, first off, this cross that could have been coming in, it can be coming in, might just actually happen here in the moving average convergence divergence, would be considered in a sense a sell signal. But there's a couple of things working against that. We have the increase in, of course, momentum and strength in terms of the histogram just here. And looking at the DMI down below, we can see that the positive DM is up in the high regions. Now, it is actually managing to persevere above the 40 line just here as the ADX remains in a position of strength. I actually would like to see this thing fly up and get another test off the top end of it. Now, we're not seeing this having happened very often, and that's because highly volatile, extremely hard trending markets that really put all of the shorting hedge funds through the butcher's treadmill actually are not, it's not that common here in traditional land for us to see that sort of thing happen. But you can see it happen in other stocks and shares, etc. out there. How about I just bring up one to show people, for instance, from the land of crypto. Now, of course, I'm not here advocating for crypto. I'm here on Jamie's channel to talk about AMC. But I would like to show people, how you get these effects happening with the DMI. Here's Doge, and you'll have all heard of Doge. It's Elon's favorite meme coin at the moment. And of course, as you can see here with the DMI pushing up towards the 50 area, which is of course an area that I would look for in terms of the 60 area, sorry, in terms of a turnaround. We did see that we got pullbacks. Now, these pullbacks were quite horrific actually as it happened, but we went on to make higher and higher highs throughout it. Now, that's kind of what I'm intimating with regards to the price action with AMC, kind of looking at it around about this sort of a region where we came up towards that 60 zone, and then it looked like things could be backing off a little bit, but we actually went on higher up after all. I wonder what the MACD histogram lines looked like at the time. Going back here, I'm gonna have to stretch this out a bit because obviously the relative difference is huge here. But if I go back over here, yes, exactly. So I was kind of a little bit trying to point out there with the AMC chart that while the MACD might be coming in to show us something like we're seeing just here, as we saw this diminishment in the strength after having had a high rise up in prices, that really, what we're looking for is to see if we can actually have a healthy pullback and then continue on up the way. So that's in terms of sort of, if you like, managing your supply lines, choosing your own battlegrounds, etc., from the old art of war, and knowing your enemy as well kicks in here. And to say that would they have the confidence to actually take a massive position based off of a cross just here, then we have to acknowledge that really they know the hubris of diving into events like that too quickly and when in the face of bullish price action. Diving back over therefore to AMC and seeing then what we can see with regards to how we could see the prices come towards that $9 area. Now, here we go. By the way, I'm just getting all of this stuff where we talk about the negative potential out of the way early on here so that I can, kind of go on to talk about the positive stuff, having done my due diligence, if you like, along the way. Before getting drawn into talking about that $1.69 million target, too rapidly or anything like that. I'm just going to check in with the chat as well and make sure everybody's doing all right out there. I just want to give a shout out to the likes of Arika, who has recently subscribed to my own channel, for instance. It's shilling my own channel. Forgive me. Xeno Swarm, good chat with him in there about oil and the likes in the chit chat. Stefan, excellent to see you here as well, and all of you good people out there. And again, just one last request, if you wouldn't mind hitting that like button to help out my old brother's stream here, that would be fantastic. Stefan S is saying right now, remember everybody, Michael J. Burry says that GME will squeeze, but like the 2008 crash, he was 2 years early. He made the 2008 prediction in 2006, took 2 years to be correct. Well, that is actually the modus operandi of hedge funds normally as well. They look at things in terms of, having a portfolio, which they try and balance their risk against one another, and they actually need, to kind of try and anticipate things very much early and then really drive it the full way for success. Now, what we have had the opportunity to do is, in terms of this stock, identify the opportunity to actually find a bottom on it, having seen the prices drop down over the period of the last 6 or 6 and a bit years really on here. So anyway, the weekly chart isn't actually giving us the identification of prices that we maybe would want to look to. There could be a couple of things that we want to see. What numbers are Jamie using here? I'm going to just move. I'm just going to stick on the 21 EMA here to make a couple of broad points really. If you are looking at this from a weekly perspective, though, and you're looking for where you could be coming in for a bounce, etc., if the prices came down towards the 21 EMA, that would be, of course, of absolutely no surprise. People maybe out there in the world of traditional stocks should be familiar, very familiar with the 21 EMA, but something in terms of just standard out of the box indicators to give people an idea about the ranges that you could be looking at. One that people are very familiar with, of course, is the Bollinger Bands, and we can see that the baseline of the Bollinger Band is in here at the same area as that 21 EMA, more or less for most of the time, because that baseline, of course, is the 20 simple period moving average. Okay, so I just wanted to kind of demonstrate that to people, and also a couple of little rules about the Bollinger Bands. Whenever we break outside of the Bollinger Bands, there's actually a 95% chance that you will not see that follow through and that continuation whenever the prices are so far extended beyond them. That's quite a well-known statistic in the world of trading. That's to say that when we had this big move up the way towards $15, $20, etc., there was only actually a 5% statistical chance that things would actually continue on the way. It's kind of from that whole category of phrases of the bigger they are, the harder they fall, or, what goes up must come down. These sort of throwaway phrases from life, which are actually kind of fairly commonly true. Well, this is kind of one of them. And it's that what goes up must come down mentality. And it's part of the natural oscillations of markets. And as you can see here, everything's working along perfectly with regards to that. Breaking out of the just here and then coming back down towards the baseline is absolutely typical. Drawing that price action then, the sort of the detail out of it for you to see, you can see obviously then that we came back down towards the baseline, up towards the top area, traced it up a little bit, back towards the baseline, and now we're in an area where things are tightening up on the 24-hour time frame, which does open up an opportunity for a bit of volatility. Now, of course, I'm going to rely on the trend, and the trend at the meantime, and actually has been since March 2020, really, to be honest, is towards the upside, and I'm going to say that that's what we will actually revert to overall, but I'm waiting to see, of course, if any of that volatility pushes us down towards that $9 price point. So how could we get there? How could we get there, Rocky? I hear you kind of crying out from the cheap seats. Just kidding. We're all, of course, in first class over here. And what we could do is we could look at the current structure of the price action here. This is the 1 hour time frame. Gives us enough to be able to make some assertions off of. And of course, what we were looking at yesterday with regards to AMC during my own live stream talking about this was the potential for the prices to be operating within a wedge right here. Now, this wedge has a couple of little caveats to go along with it. One thing that regular subscribers to my own show will know, that a little lesson that I like to drop out there for everybody frequently, is of course that wedges, when they fail, what do? They become channels. And that's the question that I'm asking at the moment. Have we got a potentially sort of failed wedge, if you like, that's just simply going to be a channel towards the top side? And perhaps I'll even go as far as the 15-minute channel time frame to show that off. But as you can see here in the 1 hour time frame, this more or less looks like a wedge, and we can look down towards the lower end of it here and see that it's at around about 985, and at the top end it's about 1029, and that's the range, if you like, in terms of where we're trading at the minute that we can focus on. Then what could we look down to see, well, is this actually that failed wedge or not? Here's the 15-minute time frame, and just let me kind of line this up properly. This, of course, starts off with this low here on the 6th of May, and then we got second, third, and fourth lows potentially in here. Now, this section of the price action has this gap here as we had an impulse up the way, and it does kind of show you that this was a downward trend. And not only was this a downward trend, but this was at the culmination of a long period of downward price action that kicked in with a massive dose of bullish divergence at the lower end of it right here, as you can see, for instance, on my RSI just here. You've got the lows increasing as the lows here on the price action itself were increasing. There was getting lower as this was getting higher. That's bullish divergence. We see this kick in the way, and I'd then say, well, how about we kind of ignore this area of it just for discussing where we've been since, and look at these three peaks that we've had, because touches in terms of channels, you're looking for three wedges, any sort of pattern really. Three is your ideal sort of number to say you've got one, and then we can draw this in here and say, well, look, overall this is where we're at in terms of it being a channel. Again, the same sort of deal with the highs being more or less the same sort of place and the lows coming down to 995. or so. When I saw the price action get this big pickup again here, where did the prices open up today? This was the opening of today in here as well. Yes, we had this massive drop down the way, and it came down towards this area where the gap is, and actually came just as far as we did before without actually filling it in properly. And then, of course, we spiked up towards the top side and put in highs today. So far, the highs of the day. In fact, in that first 15 minutes of the opening gambit of price action there on today's trading, and since then we've been operating within the range as set out by the true range of this candle here. The volatility within the first 15 minutes, kind of, the first 15 minutes really setting us up for how we're going to operate throughout the day. What we're looking for here really is to see this continuation overall and to stay above the 21 EMA. If we see things dropping down, then yeah, looking down towards that 980, 989 area. Therefore, you might be considering to yourself, well, what did you buy, Rocky, if you were to buy it today? Normally, I never talk about these things, but this is a little bit of fun. It's different. It's not my own personal channel, so I don't mind too much talking about how during this period of price action, I actually bought bought some more AMC shares in here at around about the 970s region. Whenever the prices came down the way, came towards our previous area of support and resistance and bounced back up, I actually bought into that momentum towards the top side, and it was lovely to see it happen. And of course, I'm sitting pretty ever since. Everybody who wanted to join along with me did get a second bite of the cherry 45 minutes later as we came back down again towards that area, kind of reconfirming for me whenever I didn't kind of think, oh gosh, I was wrong. Then we went back up the way that was an okay position to have taken at that particular time. We are seeing a tightening of the RSI overall here, not managing to put in higher highs as we put in higher highs on the price action. It's the same way that we identified down here that we weren't putting in lower lows on the RSI during this phase here. We can see that we're not putting in higher highs on the RSI during this phase here. Likewise on the MACD down below as well. And actually as well, you can use the DMI here for divergence, and we can see that we're getting bearish divergence in this section here. And that ties in very nicely with the idea of it being a wedge again as well. So I actually am just going to put this back and position it as a wedge, and therefore talk about the significance of this zone overall in here and what it could mean in terms of where the prices would be going next. So if they did actually push down towards the lower end of the Bollinger Band here in the 15-minute time frame, we're doing a few things at once. We're coming down towards where we saw our recent lows here at the 958, 960 region, 960, and then we would be challenging that, and it'd be 1, 2, 3 times a good in. Perhaps we could push down. This is what I would then consider to be fake out territory on any moves at the minute on this one. So I'm just going to pop this in here and say this line is obviously significant because this zone in this area, if I just bring in a sort of shaded triangle to show you what I'm looking at in terms of the fake out territory, because a lot of people won't necessarily be familiar with the way that I normally run TA and show people about fake out and breakouts. This is fake out territory, and any movement down towards this represents a buying opportunity, where a wedge simply becomes a channel towards the top side, as I've already explained in terms of how that works. If we move beyond that zone, then of course then we could be looking down towards $9, and that's the perfect buy entry because that comes in for a filling of this gap over there, and that's our previous support and resistance area for us just here as well. This is going to probably start to build up and look somewhat familiar to what we started with in terms of the horizontal lines, etc. But it's good to be doing it ourselves off the back of our own TA at the time, showing people how you do it. So there's your fake out territory, and that in many senses represents what could be considered to be your sort of best buy zone in here. So that might be what adds up to be your best buy zone at the meantime. Okay, best buy zone if no downward Momo, as in momentum. So that's your best buy zone if there's no downward Momo. If we do actually get any sort of degree of follow through, then this area right here represents your best buy area in the medium term. So best buy if bearish over coming week, right? So that's the best buy areas for us kind of sorted out, and that's all the negative stuff taken care of. Okay, so what have I done just there now? I've talked about the price action potentially being in a wedge. If the wedge fails, then it becomes a parallel channel towards the top side, and that represents a best buy in the short term period of time, giving you nice risk management for anybody trading right here, right now. If that actually pushes past that zone, then they tell you where your next best buy price is coming in at. It's around about the $9.05, $9.10 10 cents area, and that's if we're bearish over the next week, looking at this thing, trying to get in what is potentially a higher low over the macro picture, showing us that we've pulled all the way back down the way, and we're able to not come down like we did to our previous lows over here. We actually find support at this area of support and resistance once, twice, 3 times, 4 times, 5 times, showing us that this is significant and represents a higher low. Couple of little things that I would like to point out just to give you that extra clarity in terms of understanding charts, and this is something that Jamie talks about on his channel from time to time, so a lot of you should be familiar, is the significance, of course, of staying within the Donchian channel and not having bodies which close below it. Zooming on in the way here, having just added this indicator on, you can see, of course, that the lower line of the Donchian channel lines up with that best buy territory if there's no downward momentum in the meantime, or presenting a fake out from this move towards the top side, giving us yet a third line as well in here at the 21 EMA for the baseline of the Donchian channels. That might not be so visible to everybody. I'll just hide everything else so you can see where the baseline of the Donchian channels would be. Come on, show me. Here's the baseline right there. We're just below it at the minute, and that's at $10.05. What did I talk about in yesterday's video? The most significant area of resistance up above us is that $10.05. Break $10.05, perhaps we are looking at a breakout towards the top side, okay? This is, of course, the first step towards doing that. Therefore, you could say that your initial profit-taking target, and this is not for you or for me, but in terms of all of the high-frequency traders out there that, of course, provide the liquidity and you know, the more neutral perspective on what a market maker is, they'd be looking at this area and saying, well, we've got 2 of them. We've got the first one that comes in at 10.34. We've got the second one that comes at 10.48. And then if we push past those 2 zones, we are, of course, looking for a breakout towards the top side, giving us our fake out territory just in here. I'll draw it in with a rectangle to make it a little bit easier for me because triangles take more concentration. That's our sort of generic area of saying this is your risk if we don't succeed at pushing past. Now, again, in terms of a measured move, and where it takes us to, if we pop this in just here, is bring us up to, and this is a measured move on the assumption of breaking out from a wedge towards the top side, it takes us up towards these clear areas where we're challenging the resistance from the past. Let me just pop on a little line, horizontal line. I'm going to line up with this high, with this area of inflection just here, with this area just here, where these had these highs. We actually came up pushed higher, but we didn't close. Like I said, the significance of the bodies. So you can see here we didn't have our bodies closing up there. We actually just had them moving up the way. So I'm going to actually just pop in this area of in it around about that there, roughly speaking, that rough zone in there, and we can see that this measured move, if the full thing happened, takes us right back up into challenging that territory. That's extremely healthy. It's extremely positive, and of course, it's the best position that the price has been in for the last couple of weeks, and we could be looking more positive again, therefore, in terms of a trending move. Okay. At the meantime, we have, of course, got the divergence that we need to be aware of, and we could see a pullback, and that's what gives us those opportunities. Boom. Okay. That is short-term technical analysis for AMC right here and now. If you're trading this over the period of the next day, 2 days, 3 days, week, or maybe even 2 weeks when we're looking at it. And that is highly technical, highly technical. So I wouldn't be surprised if there's a shit ton of questions and confusion that arises from having talked about that. However, it is quite simple, and that is how the professionals really would be looking at this right here and now. Well, dare say so myself. I obviously don't want to set the standard for all professionals out there, but I always did consider myself to be somewhat a little bit more proficient than the professionals who I was surrounded by when I was working in the arena. So not all of them would be looking at it that way, but there'd be some of them, like myself and other people who come over and go, by jingles, you've done some good TA there. I hope the boss doesn't notice that I can't do that myself, that type of thing. Anyway, so to speak, that's what the professionals are looking at. Afterwards, where's our next target up the way? And it's actually, in terms of the next move up, what we're looking to here is a solid 50% rise up in prices from where they are right now, even to get up towards $14.29. This would take us up, of course, towards where our previous high was. That makes perfect sense as I scroll back in the left and show you more price action. As I jump up towards the 1 hour time frame and then the 12 hour time frame, you can see that it brings on more more price action, you can see if this line, which is our next target towards the top side, bears any significance in the past. And we can see in here it did, in here it did, and we can see that this candle, which pushed right the way down past that in one sudden movement, also confirms it for us because of its because of the shock move through the line. Then we have, of course, this area here we found support at, and then back over here. You know, this is a long time ago, back in 2013, and this is when things kind of kicked off, and this was our very, very first ever area of support. What's so significant about going past our very first area of support? Well, I would say actually this is where where you want to have your starting pistol fire, and this is when actually the emotions kick in for people in terms of the overall positive upward trend. If we take out that line, that's extremely exciting for us in terms of our price action, in terms of our potential to move up the way, bringing in then even bigger targets, because we know that essentially at the end of the day, this has got a value play aspect towards it. You know, we like to talk about the short squeeze, etc., but we know there's a lot of people who are not even necessarily going to engage in activities surrounding the short squeeze, or like reading us talking about it on the likes of Reddit, Wall Street Bets, reddit.com/tradespotting, etc., where we talk about these things. Maybe, you know, there's people out there, let's be honest, who are value traders just looking at the historical information from the past and saying, where could things go? And I would like to invite them to be aware of this little dynamic we have right here. Between the highs and the lows, they've got an area right in here which shows us that we have got an overlap, a confluence, and it's the 50% line from the highs to the lows. It's an area, a 50% line, and that's extremely significant. What does it mean to be breaking past that 50% line? Okay, let's just ask Google, this is the Jeopardy answer, Dow theory. What is Dow theory? Okay, this is the Jeopardy style answer to that question. Dow theory is a technical framework that predicts the market in an upward trend if one of its averages advances above a previous important high, accompanied by or followed by a similar advance in the other average. Now, essentially what that's telling us is that if we go past certain areas, now of course that doesn't tell us what those areas are, but I'm here to summarize and synopsize that information for you, and the number that you're looking to is the 50% area. So we have that confluence in there giving us this picture for the overall strategy towards the top side. Now this is just from a value trader perspective. Where could we be going if we do take out 1480? Well, obviously eyes will be drawn towards 1786 for numerous reasons. I'll not break down too much detail, but that's your golden pocket retrace. But actually, you know, at this point, we really are looking back up towards our, well, and because of this significant area of a high just here, which is the most significant, you know, retracement towards the top side during the 6-year-long downtrend. So there's that. And then, of course, this is our very first initial area of resistance towards the top side, where the first area of liquidity from people taking profits in this one on this chart came in at, right? Okay, so there's two significant, so I did break it down anyway. There you go. So then we were looking up towards the top side, however. We're looking up towards the top side, and this is when things really start to happen. So when people want to talk about whether or not the squeeze will be squoze, it is at this price point here, $27. $27. $37 is actually probably more realistic in terms of really kind of getting people to get properly wet in their pants about things. But of course, this is when the squeeze begins to squoze, okay? This is where the squeeze really begins, okay? Really begins, and it's not actually that difficult to kind of understand why that would be the case. Now, despite all of the numbers and everything else that you read around on the internet, we're going to be aware of the fact that prices did actually operate up here, not once but twice, offering up a nice degree of liquidity for people who have obviously been able to short it from those highs. What did we see here? Did the prices go higher? No, they didn't. They went down. What did we see here? Did the prices go higher? No, they didn't. They went down. We know that there's a lot of people who've got positions then therefore which are negative, and we know the hedge funds have been shorting this for a very long time. Who is it then therefore that has these that started off with that position? And that is of course our enemy. Know your enemy. Check. Let's just be aware that we know our enemy, therefore that we know our enemy, and that we know that they're not really going to start to be squoze until we really see prices push past 27, because of course they've been there, done that, bought the short squeeze t-shirt back then, if you like, with regards to that one, and won. So this is where hubris kicks in at for them massively. You know, at the very least, they'll be thinking to themselves, sure, there might be a value play on the go, but that will end at the very best at $27. AMC will never be worth more than it was back in 2014. That's what they think, okay? So so I've explained the significance of this area now, and I think I'll actually draw this one in and be so blazing as to put this in here with a green colored line, just so you can see that, of course, that is the starting area for us. Where are we looking then, therefore, in the immediate aftermath, the immediate upflow from this territory, and we're looking towards 1618, and that comes in there at $43.78. However, this is all a little bit lackluster in terms of those $1,000 targets, etc. And that's because what I'm doing right now is looking at this on the linear chart. If I go up to logarithmic, because this is going to become a logarithmic requirement, is going to be required to look at this in a logarithmic sense very, very soon, sooner than you would think, of course, absolutely no doubt about that. And bring up this charts full screen. In fact, we don't really need to talk about the oscillators when it comes to the speculation at this point. And we can see that these targets here, extend up quite a wee bit towards the $148 area if we actually do start to get to see the squeeze starting to get squoze, okay? And it's only really when we push past $148 that actually becomes the writing on the wall, and they're all completely and absolutely devastated. You know, so if you're looking to knock the billions and billions of dollars off of the valuation of these hedge funds and their overall portfolios, then you're looking towards breaking past that 140. But that 140 opens up an amazing arena for us. Looking at this as well, let's just be aware, because the this zone is, of course, where you're going to have the sort of the majority of people who are the Fugazi diamond hands. Now, you know what I talk about when I say Fugazi? Diamonds are, of course, the girl's best friend, but of course they're a real thing, and you get these fake diamonds. They look an awful lot like diamonds, and they're known amongst the diamond community as Fugazis, or at least from my watching of Lock, Stock and Two Smoking Barrels, that's my interpretation. And I'm looking here and saying that the Fugazi diamond handlers, of course, would be closing out their trades at $2,250. But we've got bigger targets to take on board. And I'm actually going to kind of summarize this and wrap it up by going back over to the Dogecoin charts again. So please do bear with me. Again, it's not me trying to push cryptocurrency onto a market which maybe is more interested in stocks and shares, etc. It's me using factors from technical analysis, you know, and we're not talking about the entire economy crashing, etc. when Dogecoin goes up to 65 cents. You know, that's not what happened. But we can still talk about these extremely amazing targets. And then I'll leave it up to you to decide how realistic they are at the end of it. Let me just pop on what is the two targets that you could be looking to beyond those regions. I'm going to be putting in the 3414, and I'll make that one yellow, and I'll put on the 4414, and I'll make this one orangey red color, a rusty color there, so that we can see the two different numbers showing up visually for us when I remove this. Because, you know, it's a bit of the drum roll, please, brrrr, reveal section just here with these two price targets. And boom, here we go. There they have them on the screen just now. And you can look towards a couple of areas just higher up. We've got $20,000 in here with the 3.414. And then, of course, you've got $295,996 between these two prices just here. Now, of course, this does change fairly dramatically with just a few pixels difference in terms of where I've dropped this in at. So you'd want to be fairly accurate with this. But really, in terms of like just kind of giving you a couple of ideas, just hear a flavor of an idea talking about things. We're talking about big, big, big numbers. And is it justifiable to get there? Well, it absolutely is. And I'm going to move on to the justifying how we get there section in just a second or two. But what this really is to show you, it isn't like your strategy or any of that sort of stuff. And we can talk about strategy, and I've talked about strategy in a previous video. If you check out my channel, of course, that's youtube.com/rocky.outcrop, ROCKYOUTCROP, then you will see, of course, my AMC exit strategy, where I talk about similar things like this, using a slightly different position Fibonacci to give us extremely wild targets towards the top side, and it's a bit of fun and it's good laugh. But what we're talking about here is like when we go into the world of madness, etc. And I really want to draw out the point that we're not in a world of madness right now, that the price is moving up 50%. While it would seem from a traditional trading point of view like a really massive move and everything, you know, should be done and dusted by then, we can extend it up even further and further and further. And I've shown you time after time after time, whether it's from a value trader perspective or an investment over a longer period of time, whether it's from just looking at it from a technical point of view, whether you're talking about various different ways of approaching this subject, that, of course, you know, you can see the price is going up to $150, and then it's when the hubris of the, you know, the outcome of that hubris, you know, the actual fall from grace really kicks in, and that $27 is absolutely, you know, within reason just from looking at the charts. Now, I know we could look at the various numbers out there, but I just want to say to people that there are going to be some people out there who feel like they're okay until that point of time, that, you know, they feel like all they need to do is just to balance out the books, using an accounting style way of making money and just try and beat inflation. And all they really need to do is balance out the checks and balances. But it's when it goes beyond that point that things really start to get tasty, extremely, extremely tasty, especially whenever the value traders drop out. Because when the value traders drop out from this thing and take their profits and see the prices continue up anyway, because the likes of BlackRock decide to just push this and push it, because this is what you can do. It's not illegal, and it's actually a fully good and absolutely perfectly legitimate thing to have in a free market. If you want to have free markets, then this has to be possible. If you don't want to have free markets and you want to live in a socialist state, then by all means go to Cuba and take up your trade in there and you know, enjoy that. It won't work very well. That's why this has to happen. This has to be part of what we accept as being part of our economy. We just have to, or else we want to live in a socialist state. So what are we going to do? Let's embrace it and see that we could in fact see prices go crazy, but it only really happens whenever the value traders have dropped off and everybody's saying, well, look, no, there is a new narrative here. So what I really want to see is everybody getting onto the same page, of course, and the same page happens whenever the prices have gone up so much from here that if you're to put in $1,000, you know, for instance, right now, I'm not a financial advisor, none of this is financial advice, then you'd be looking without any leverage or anything else, and then you'd be waiting and seeing that your $1,000 had turned into $3,000, for example, and you'd still be looking at it saying, that's not enough for me to take my money out. I'm looking for it to go higher and higher and higher. You know, that sort of mentality, and that will start happening when people, you know, kind of see the prices going past that point. So that's kind of what I'm looking to on that front with that one. And I wanted to kind of try and justify it. I mean, how can you say that we could get up to 295,000, Rocky, because that's where that 4.414 is? Is that realistic? And I know there's a million different ways that I could do it. And I'm using Doge purely simply because you will have heard of it, okay? And this is something that I think everybody has heard of that's in this community. You know, I could use any cryptocurrency. I've done it thousands of times, and there's plenty of other stocks out there that I could happily use to do it too. I just wanted to give something that's a relevant example for people to look at, and let's try and do something fairly similar ourselves. Let's say, for instance, that this was the all-time high on Dogecoin, and this was the low. Okay, let's just put this into context for us, by the way, by saying that what I'd done with my Fibonacci was I was looking at this high down to this low. Okay, highs to lows, right? So we're not doing anything radically different there in terms of looking at the differences between these. Okay, so let me just bring up the chart again and show you. So if we're looking between this high and this low, and I pop in a Fibonacci retracement and show us, then where did we get to? And you can see the 4.414 coming in here with the highs that we had recently. You can see that right there, and then you can see it. Now, did the whole entire world melt down when this happened? No, it didn't. What conversations have you had about Dogecoin at any time in this period here? Let me just draw a rectangle on and ask all of you out there in the audience, what conversations have you had about Doge in any of this period of time here? Was it conversations like, this thing is worthless, but it's going to go higher anyway? Is that something that you might have heard at any time in this? At any time since, you know, perhaps in the last, you know, couple of months, while we've seen a 13,396% increase towards the top side. At any point during that 13,396% increase towards the top side, did anybody say, this can't happen, it won't happen, you're a fool, etc.? Probably quite a few people. But look at what's happened. And we're saying all it took was for Elon Musk to be talking about it. Now, can you imagine if you turned on the TV this one morning and said that, and you saw the headline was on CNBC, the first thing they were saying was, some group has gone bust because they can't afford to do anything. Because they went bust, they had to put so much money into another, you know, they had to liquidate their position, which sent the prices even higher. And because they've done that, it looks like other companies are bust. They're having a special meeting today to discuss it, etc. Can you imagine that news came out? Do you think people would therefore then go ahead and sell the stock, which these companies are looking to have a special meeting to decide how they're going to actually strategize at that point, how to recover? No, probably not. I'd say that people will probably want to buy it at that point, because that is, of course, how the markets have always worked. One thing that I suppose that I will talk about now that I've come to the end of this overall section, I've done the TA in terms of the short term. If you're trading this today, if you're trading it tomorrow, you're trading it over the next couple of weeks. I've done the longer term perspective in terms of your upper side targets. I also started off with the risk management, by the way. I talked about the distinction between value play and, of course, as well, the speculation aspect and the short squeeze. I talked to give people a little bit sort of more breathing room with understanding at what the context would be of a squeeze and how it would really look. I talked about an upper side target that brings us up from where we are now, hundreds of thousands of percent towards the top side, around about 295 grand, although the numbers at that point become more or less arbitrary because, you know, we'll cross those bridges when we as a group of millionaires get to them, right? And then as well, I've justified all of it by showing you that the things that I was talking about, despite seeming outlandish, are absolutely something that you've known about being possible and have witnessed over the period of just the last 2 months. Okay, so since we've got all of that completely together and there's no need for me to give any further justification for any of that, there's this one thing that keeps getting thrown up towards me, and I keep talking about it all the time and people don't really understand it. And it's this simple question of, can you do technical analysis on a manipulated market, right? Or can you do technical analysis whenever things are going crazy? Or can you do X, Y, and Z? Can you do technical analysis whenever this reason I've been told it doesn't work exists? You construct your own sentence. I don't want to put words in your mouth, but you damn well know what I'm talking about because a lot of you out there have actually asked me that. And what am I doing with the Dow Jones Industrial Average on the screen here? Well, you know the name Dow. I actually referenced Dow earlier on when I was talking about Dow theory. Dow was, of course, well, who cares about Dow's history, right? When I talk about Dow actually in the Dow Jones Industrial Average, I like to talk about how there was a guy called Dow and there was a guy called Jones and they were lovers back in the day. Now that's just, you know, making a laugh because that's not the case, or at least maybe they were lovers. Who knows? But what is this thing? Well, it's basically where your entire understanding of markets, etc., and what we're doing here comes from. For the vast majority of people who are in the live stream right now, this is the biggest dominating factor in any thought that you've ever had about technical analysis. And if there's one that's competing with it, it's perhaps something like the S&P 500. However, everything you ever heard growing up relates to this. And let me then just take this historical, amazing piece of information and use it to demonstrate to you the answer to that question. Can you use technical analysis to understand these things? Bringing in the highs that we had in the 2008 crash. Was it possible? Now, this is something that I didn't really understand back then, but I sure as hell understand now. And of course, this has led to me getting a lot of wealth in my own life, not least of which is the wealth that comes from not having to work with a group of morons inside a bank that don't really understand what they're doing themselves, even though I'm there with them telling them all about it. Haha, just kidding, not bitter, just laughing. But in this area just here is where we had the highs of the 2007-2008 crash. And of course, we can see, and at this point here, that there was, of course, divergence on the RSI, for example, Now, there you go. There's some TA in the face of extreme market conditions, which people back nowadays would like to say, yeah, nobody really knew it was coming, etc., etc. Now, the guy in the chit chat we had as well, as somebody said earlier on, that somebody predicted the crash 2 years before it happened. Well, they predicted the crash at this period of time here. And of course, we saw the markets, of course, continue to go towards the top side, following on from that prediction. What were they doing when they were predicting it? Well, they were predicting it in the face of course, convergence on the charts. And it was a bit silly to be making that prediction 2 years in advance. That was actually foolish of that person to be saying it. However, they were ultimately proven right. Were they proven right because of fundamentals? No, they were wrong by fundamentals for 2 years. But in terms of actual technical analysis, would they have been right had they traded at the time? Yes, they have. Okay, score 1 for technical analysis. There we have it. There's 1 for technical analysis, 0 for fundamentals. There we have it in terms of our little trade-off here. So let me just keep that going as well. Bearing in mind that if a lot of people here said that things were going to go bad, a lot of people and it wasn't just him, it was lots of people for more than 2 years were saying it, really, to be honest, including the UK government, the American government, and everybody else. I mean, a lot of people in the sort of forward-facing elements of the American government and the Fed, if you like, then were talking about how, it won't happen, etc. I mean, you had Gordon Brown as well back in the day saying, "Gone are the days of boom and bust." Do you remember that absolutely seminal UK budget speech? Of course, one of the most famous budget speeches from the UK since the war era ended. So, do you remember? That's what that was like back then, but fundamentals meant shit. shit all, and we could see it right there plain as day on the charts. But nobody's interested in the 2008 market crash, Rocky. We're far more digital people. We're digital. Could we have possibly have seen that there was a problem here in the dot-com boom crash? Could we have possibly have seen that at all during this period where we saw upper side price action going in for these peaks here, as we see, of course, that we came into oversold territory and put in divergence at this period of time in this peak area? Could we have seen it? I think that's actually, let me just say here, score 2-0 to the old technical analysis versus fundamental analysis there. Yes, we had everybody and their mother was putting money into stocks at that point, and they were absolutely right up until, of course, they were wrong. When would they have seen that they were wrong? Well, they would have seen it right here had they looked at the charts, for example. So score 2 to yes, technical analysis is useful. First off. Secondly, is it useful during periods of extreme market conditions where irrationality kicks in and you can't really tell what's going on? Well, I dare say it's more useful than ever in there. And 3, does it work and can it be used to do this sort of stuff? And what's the value of fundamentals? Well, it's like 99.999% technical analysis, 0.0000001% fundamentals. If you want to, like, you know, talk about it in ways which are closer to reality, but obviously still extreme and not true. In the same sense that saying it's 80% fundamentals to 20% technicals is absolutely not true. But I know you don't believe me, because what you're saying at this point is, Rocky, look, technical analysis that you're using here, such as the RSI, was invented in the 1970s by a guy called J. Wells Wilder Jr., just like the DMI down here was invented in that same period of time. And we didn't have the maths then, we didn't have the computers then, we didn't have the knowledge, etc., etc., and we didn't even use charts back, whatever before then. It's only since these things, and it's a self-fulfilling prophecy. That's what you're saying, isn't it? You're saying you're just using these things and they're just self-fulfilling prophecies. And I bet you any money, if you went back to famous crashes in the past before these things were invented, you wouldn't see that. Okay, then, I hear you. Well, let's go back to the era when people started using technical analysis as charts. So what we're talking about here is the 1930s. Of course, people did use them in Japan for a long time before. It was a French guy that was working in the American NYSE at the time. He didn't speak very much English, but he's the first one to start using them in there. This is the era where we had the likes of Gann, etc., blah, blah, blah. Now, Now, they started using them then, but they were known in around about this time by the majority of people. Okay, and what did we have here? We didn't have the RSI. This isn't an option. It wasn't there then. We didn't have the DMI. That wasn't there then either. But let's just use them now as if we did have them. What do we have here? A peak here, and it's hugely divergent. What did we have here? We had a peak here, and it wasn't divergent compared to the previous one on the way up. So we could see that, of course, we were on the way up, but then we got that divergent peak. Not only that, but in fact, if we look back to the sort of the previous low up to this high, and we draw in a Fibonacci retracement, again, something that was, of course, known in a sense, but not used like this. You can see that we broke the 236 there. When we went down below it, came back up again and broke down below it again. That, of course, that the inevitability was that we were going to go on to the 618, but we might have even have gone on beyond it to something like the 1.272 over here, as we did see the ultimate bottom came in at around about the 27th of June 1932. Okay, you still don't believe me, because like I said, charts were in use back then, and Fibonacci was, of course, invented. Oh, I hate to have to prove this to you. I hate to have to do it. Let's go back to the frickin' the daddy-o, the number one, the famous, the big old, the daddy, the biggest one ever. What we have, actually, no, that's the truth of that is maybe what I just discussed here. That might be the one that everybody wants to talk about as being the big one. Of course, you've got the likes, so you got all that sort of stuff happening. But there was numerous other crashes in the past. How about we just take, instead of doing it sort of all like that, how about we just take every single peak? 1, 2. There's a peak. There's another peak. 1, 2. There's a peak between these two. You can see. Look at this. Highs, lower highs, bearish divergence. What did we have following on from that? Let me just see here. What did we have following on from that? What did we have? Let me just see. We have, take this Fibonacci in from these lows to these highs. Oh, look, we broke the 236. I would anticipate at this point that we'll probably go down as far as the 618 Fibonacci golden pocket. Let's just see what actually turned out happening. Oh my goodness, that's where the market lows were for the whole market, and then the prices went up. What do you mean, Rocky? Oh my God, are you actually serious? Are you actually proving to me in front of my very eyes that technical analysis has always worked, that these things that we talk about as being self-fulfilling prophecies have always been the case anyway, that there is actually a method to the madness, and this stuff is actually not bullshit, and I didn't tune into this episode just to be completely lied to, and this is all true, and you've just gone through and verified everything and audited everything you just said and made it all proof and fact and pretty much indisputable? Is that what's actually... Yes, it is. Thank you for joining us. Welcome to the show. Like button is, of course, appreciated. If you're getting any value out of this, and I dare say everybody out there in the audience probably is finding out something. I will check in with the chit chat to see if I've missed anything in a few moments, but let's just see if we can keep this going on the way, shall we? Shall we see if we got any sort of other things? Here's something that I've never done myself before, so I'm interested in seeing if it's possible, right? I've never done this myself before, so if we had this first rise up here in this price action, I'm actually getting excited here. Sorry, this is crazy to get excited about doing technical analysis, but you know, takes all sorts, doesn't it? Right, so we had this rise up here in the prices. This is, of course, back between, you know, the good old days of 1896 and the highs of 1899. Let's see if any of this gives us any idea about future price action at all. And we'll do it by measuring against the retracement between it. Now, we already know it went down to the 618 golden pocket over there because we did that Fibonacci already. Let's draw in one that measures the retracement down the way. Now, I'm not going to do it penny exact. You can see I've maybe missed a pixel just there. Oh, forgive me. Let's just see if any of this makes any sense. Let's see if at any point in time we went to that radical 4.414. Let's see if we ever went to the 3.414. Now, I've never done this, so I don't know the answer. I don't fricking know the answer. I could be eating humble pie in just a second. Let's see if we ever went to any of these levels. Now, I'm not just choosing numbers, randomly or whatever. These are specific numbers I'm specifically choosing based off the back of this here area. Let's just see as we go over to the right if at any time there's any degree of inflection with this. Now, this is coming out of nowhere. Nobody at the time knew about this technology existing at all in the world, pretty much, and nobody had ever thought to apply it to a chart. They didn't have the technology really or the know-how to make these charts in most instances, and they weren't looking at it in any way. So is there any reason in terms of a self-fulfilling prophecy that this would happen? Absolutely not. It's the complete opposite of that. So let's just see if we see anything, any interaction with these lines at all. Oh my goodness, you're not going to tell me, Rocky, that the peak of the next peak in 1930, you're not about to tell me, Rocky, stop it, Rocky, stop it. You're not about to tell me that the peak that the markets had in October 1929 was the 4.41 Fibonacci retracement point from the peaks that they had in 1899. You're not about to tell me that, are you, Rocky? Okay, I'll not tell you that. So you can see how this is obviously has an impact, that the prices, they found support here, they moved up to this area, and that's where they found an inflection at. Who's to say? The price is about 241, they found this inflection at around about that price. Who's to say? Why did the prices operate in this area so rigidly? Why did they find resistance at this area again and again and again? Why did that happen? Why did it come up, peak at this point, pull down, and then find resistance there at that time? I mean, we know that it's got to be some sort of self-fulfilling prophecy fundamental reason. There's got to be a fundamental reason why that's happening as opposed to a technical reason on the charts. Right. Am I right? Anyway, so that is of course, the most well-known chart in the entire world. And that is just a little snippet of looking back and trying to audit what we're talking about here and seeing, is it at all reasonable to be making any of these assertions? And I would just like to say that, it probably, possibly, potentially might just be within the realms of reason in terms of what happens on this planet when we do things together as a group of apes. Could potentially be. Okay, not going to go into any more detail in that. I'm actually going to just check in with the chart, see if there's anything disgustingly obvious that I missed out. Just bear in mind that, of course, if you want to run through this yourself on your own charts and audit everything that I've just spoken about, by all means, replay this section of the episode here that we're doing and listen to me chatting through and kind of looking at things and think to yourself, how would I do that on any other chart? And here's a couple, just I suppose, to kind of finish it off the way for us. Let's just see if there's any examples here. A random example off of Jamie's chart. Shall we take a look back in the past and see how would it be? What about the Nasdaq, right? The Nasdaq itself. How about we take a look just really quickly at something like this peak that we had in here in the 2008 crash. Is there any way of knowing? Is there going to be anything at all that gives us any idea about where the ultimate market highs would have come in at on this one? Is there anything at all that could have given us any idea whatsoever? I think I've think it's probably, you know, it'd be disingenuous for me to say that there is, because I actually don't believe in technical analysis whatsoever. So I'll not say it. I'll just draw on these random things and kind of leave it up for you to arbitrarily decide. In fact, let's see how we're doing right now with regards to this peak up here, with regards to the very initiation of this, of the Nasdaq. And this is just one methodology for doing technical analysis. There are literally thousands of them. Let's see how we're doing. Okay, cool. So we've made it past the 2618. Would it be fair for us to think that we could see the American economy push on up the way and actually go another 30% increase towards the top side? Is that what that is? I don't want to get my maths wrong, because that 60% increase. Could we get another 50%, whatever, 50% increase in terms, yeah, should have worked that out easier. It's clearly 50%. Should we get another 50% increase in NASDAQ towards the top side? Is that possible? Is it at all possible? Could we get that? Would we see a pullback down here? Well, and is there anything to be thinking of in this region? Well, there might be. There might be. There might be, but you're absolutely free to do all of that yourself. Of course, I've kind of gone through the sort of the initiation phase, if you like, many years ago with regards to technical analysis, and by this point, of course, you know, I'm obviously drunk the Kool-Aid, if you like, but I'll welcome everybody to do that. But anyway, let's suffice it to say that when I jump back over to AMC and take a look at its charts and just kind of summarize real quick and say that, to me, I think, right, and this is just my opinion because I'm not a financial advisor, and none of what you see on screen right here, right now, is financial advice at all in any way. But to me, when I look at the charts, and I think that I wouldn't mind looking at buying it around about that zone. I wouldn't mind buying it around about that zone. I wouldn't mind it, you know, and that I wouldn't mind seeing the prices go up towards these other areas, and I wouldn't be shocked to see this be a significant zone, and I wouldn't be totally and overall completely blown away at all if we did see the prices extremely go up towards that zone. Is it within the technical possibilities? And you have people say to me all the time, but is it even realistic? Is it even possible? Could it even happen? Is it something that could even happen at all? And the answer is, yeah, it could happen, right? And you know what? There isn't actually that many AMC shares out there, not really. And if the prices of them go up to those really high numbers, it isn't really all that much money. It's not all that much money. It doesn't take, you know, the entire world to pay us all. It doesn't take necessarily. We don't have to make it take the entire world's wealth to pay us off. It's totally feasible. Right. How's the chat getting along? Nice to see everybody putting rockets in the chat there. That was a bit of fun, wasn't it? As well, TradeSpotting chatting away with everybody in there. I'm going to have to hand back over to TradeSpotting and let him see how he's getting on. But I'm just going to scroll up the way and see kind of more or less, if I'm looking in here from when TradeSpotting started talking on his own show, and I can see if there's anything kind of jumping out at me from what I should have looked at. Just seeing that nice chat going along with people. Please do talk about Dodge, says somebody earlier on, and all that stuff. Nice one. I'd like to see DFV in a bar and share a pint with them. Absolutely, I'd agree with that one. Just scrolling on down the way, slowly but surely. Let me see. Yep, everything seems to be good. I don't think I've missed anything. Julian says, I'm not joking. You and Rocky are very, very special in the YouTube scene. Your streams are so valuable, funny, and overall chill. Other YouTubers chase the numbers, but in the end, quality wins. Well, thanks so much. I mean, everybody here who's tuned in knows that this is an extreme privilege for me. I'm really grateful for Jimmy to give me this opportunity to talk to all of you out there, because you know yourself that my peak... Oh, this is too loud. It's too loud. The microphone's too loud. Whatever. You'll know yourself that my peak with live concurrent viewers on any live stream that I've done, bear in mind I do 3 a week, and I've been streaming on YouTube for a year and a half, and I've got over 1,500 videos published, is of course peak concurrent 60 or something like that, you know? So I'm not chasing numbers over here. I just provide the quality. That's all I've ever done, and I think that the world will, of course, come round to seeing the light sooner or later. But for me, all I need to do is focus on quality and having a good community, and that is you guys, every single one of you. Fantastic, Lamau. I love Rage Rocky. Sorry, yeah. I don't know. Sometimes maybe I seem a bit. Maybe I'm a bit emotional or something when I'm chatting. I don't really know. As for me and my wife's boyfriend, we love the stonk, says Brian Shim. That's fantastic. As do I. You know what? I have some AMC shares, and I'm really lucky to have them because actually my wife's boyfriend sold his fake leg to give me the money to buy them. So really lucky guy. Thanks so much, Spencer, for calling me a wizard. Thanks so much as well. How does a does Fibonacci spelling, absolutely, man, every time I write Fibonacci I spell it wrong, talk correspond to typical statistics and the bell curve and the standard deviation? Is it just different ways of looking at these things? That's sitting bull. Well done to you for giving one of the a real intelligent question in there. Fantastic, nice one. Let me just caveat everything that I'm about to say by saying I fucking hate maths. By the way, I hate maths. I've always hated it. It's why I did my maths exam a year early in school, and it's why I got it's why I tried as hard as I could to get 100% on it. God damn it! I did not want to have to do that maths exam twice. Give me an A star. I don't want to have to do it twice. That's always been my attitude. Has always been my attitude. So I hate maths. I absolutely hate maths. Just determined to get as good a result on my maths test as soon as I could so that I could absolutely begin forgetting it immediately as soon as possible. When it comes to talking about things like standard deviation, I have to say I've done a really good job over the last 20 years of eradicating those math concepts from my head, because I really just... I'm not joking. I dislike doing maths. I really do dislike it. Nevertheless, how does it correspond to typical statistics? Well, typical statistics, it corresponds very, very well. I mean, typical statistics, if you're talking about your question there is generic to the point that I can't actually tell you what typical statistics you're typically speaking of, specifically to correspond to your question. But Fibonacci retracement, Fibonacci himself, of course, derived these numbers by looking at these amazing relationships with maths, and it does go to the very core of how everything works in the world. I mean, this shape that I have on my ear, you could work that out, what that shape is, using the Fibonacci sequence, etc. I mean, it's just very much incorporated into nature. It's just something that happens, and it's fair enough. There's many numerous reasons for it, but when it comes to things like the bell curve, etc., and the standard deviations, then you're not really looking at using sort of standard deviations away from a Fibonacci. If I understand your question correctly, no, you just more or less stick to what the Fibonacci is saying as opposed to looking at standard deviations. And if you are talking about standard deviations, then the standard deviations away from the Fibonacci are quite simply put the other Fibonacci levels. That's the interrelationship that you have between these maths. But nevertheless, I think if there is a question to be talked about and something that's relevant to trading, which actually straight up uses standard deviation as part of its calculations, then it's quite simply got to be the Bollinger Band. So if I remove all drawings from the charts yet again and then add in the Bollinger Band indicator, you can see that in the middle of it, this thing is constructed in a fairly simplistic way. It's actually very, very simple. Now, the guy John Bollinger that invented it is still very much alive and kicking today, so if you want to talk to him, you can. I've spoken to him a couple of times on Twitter. It's not like me and him are friends or anything. You can totally find the guy. He's alive. How does he trade? Now, interestingly enough, John Bollinger himself was a big believer in stop losses, trailing stops. So when it comes to GME, although the guy's absolutely embedded in the institutions and would most likely not come out as being a proponent towards any short squeeze, overall, because he's part of the gang, but by the same token, if he was trading this, would look towards putting in a trailing stop to manage it, and that's how he would manage his exit strategy. Okay, that's absolutely is. It's just, if you want to go and research John Bollinger, the guy that invented this indicator, then that's how he would manage it. So you could go ask him, whatever he'll tell you. He would use the trailing stop to manage his position in the area of course, profit. Now, this is the 20 simple period moving average here in the middle of this line, and I can demonstrate that to you quite simply by just popping on the 20 simple period moving average and showing you that here. This is, of course, EMA1. That's what that is there on this indicator I'm using. This is MA1. That's moving average 1. Moving average, just simple moving average. Change this to number 20. Pop that on there, and as you can see here, that line that was white is now a sort of orangey color as it goes along perfectly. So there you have it. That is what the 20 period moving average is. And what the 20 period moving average is quite simple, and it is the simple 20 period moving average. It looks back over 20 periods. So the number which is calculated right here is an average of the prices in this zone right here. This 20 period zone here, take all those numbers, add them all together, divide it by 20, you get that number right there at 989. Of course, right there indicating to us where things start to get tasty if we do see pullbacks, etc. And that is where the 20 period moving average is. Now, what are these two lines here? Well, they're actually two standard deviations away from the moving average. Now, you'll find a lot of other people use different numbers for this, but actually, funnily enough, the ones out of the box are better. So we have it, two standard deviations. If you ever read something like the Way of the Turtle, a trading book which tells you from a guy who was the most successful trader as part of a group of traders who were called the Turtles, who were taken under their wing, but I forget it, a really famous guy from back in the day that wrote a book, right? You don't need to know the details. What he used quite often was other numbers. I think, in fact, he even used something stupid like 3.5. I'm not 100% sure, but to me, this is fairly useless overall. However, if you were looking at it from a 3.5 perspective, it did perfectly kind of show you where we could be seeing things going in this region just here. So there's arguments to be made for either or. I find that less useful, but I would talk about standard deviation and talk about movements away from the mean here, which is what an average is. A moving average in this sense, where you're dividing it by a number of things divided by the amount of periods. That's a mean. So this 20 simple moving average is a mean. And in terms of movements away from it, you tend to stay within 2 standard deviations of that mean, okay? And in terms of the overall concepts of anything in life, is a reversion towards the mean. It's how we do things. We always expect there to be a reversion towards the mean. When your husband, your sister, your wife, your brother, whatever, is treating you mean because they're a big meanie, and then they're nice to you for a couple of days, and you think, oh my goodness, my husband is actually the nicest guy in the world. I'm talking to all the ladies out there, or indeed men. I don't know. It's 2021, right? Whatever. And then you think, oh, maybe I married the right guy after all. And then a couple of weeks later, he's back to being an arsehole again. What that concept is known as is reversion to the mean. And it's seen here in trading in general, that prices move away from the mean, they tend to move back towards it again thereafter. And a really popular tool to be talking about the reversion to the mean. In terms of trading on smaller term timeframes, of course, intraday trading is what we're talking about for this one, is of course to look at a thing called the VWAP. And the VWAP is the volume is the VWAP's another indicator. I'll not bother breaking down what it is. But you can see you can add it by typing in VWAP, right? Volume weighted average. Oops. I'm sorry. I'm taking advantage here. Taking advantage of the indicators. I actually didn't want the Bollinger Bands on anyway. So you've got VWAP, and you can see here this is of course volume weighted average price, and gosh darn it, right, style. This is I just wanted to show this as an example to people. This is just education. Sorry, I tend to go back. I've got this thing where I educate people about stuff. I find it fascinating. I'm just sharing my passion with people. I hope you don't mind me sharing my passion with you overall. Anyway, you got the VWAP over here, and you can see, I just want to, you've got your standard deviation thing. To my friend out there sitting bully, wanted to talk about standard deviations, etc. Trying to really try and answer people here. I'm going to just stick these to 0 so that they actually all line up the way. I've just got a single line for VWAP, just so I can show you in terms of the small term prices. Now this is the average price essentially that anybody's paid throughout the day for this thing, and there tends to be a reversion towards the mean in terms of how this thing works. So as you can see here, the price, the day started here. This is the start of a day. The prices dropped down. They reverted to the mean. They came up above it. They reverted to the mean. They went down. They reverted to the mean. They went up above it. They reverted to the mean. Down below it. Reverted to the mean. Down below it. Up to the mean. In fact, we also had that happen in there as well. Up above it, down below it, 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 up above it. And that's where we are right now. And this is why it's actually easy enough for me to say a couple of little things about the price action. We're above the mean right now. That's good. We could then therefore expect to see movements towards the top side, because on average the prices are higher than they were on average. People think then therefore the psychology is bound to be in terms of the average person, the average price bought throughout the day so far today, that right now the prices are doing well. The reason for that is because they're actually up above that $10.05 area that we spoke about. It's no surprise to me to see that the VWAP itself is actually coming in at that area we already identified, $10.05, as being the current support and resistance. So people who are familiar with me will always see that I basically have an all roads lead to Rome type strategy, or approach, that I'm actually able to see the confluence and the overlap between different indicators and how they all work together, and understand the maths by jingles. I hate maths. I don't make any bones about it. I'm quite honest. I hate maths, but I understand it. I'm obviously good at it, but I bloody hate it. So by the way, when I make that joke, what I'm trying to say to people is that you don't need to understand this stuff. You don't need to like maths. You don't need to be a technical person to do all this. Understanding these things, which you will understand, I assure you, over time, when you follow along with the likes of TradeSpot, who's very, very good with his education, is that you'll develop these things and you'll understand them intuitively. The reasons that I talk about these things in such explicit terms and talk about how I don't like maths and everything is just to make it more sort of engaging and feel feel accessible to people. The truth is there is no real mystery here when you can see behind the curtain, and I'm very happy to be the man that reveals you, you know, Oz, the Wizard of, standing behind that curtain there and giving you the insight that you need, right? However, you know, what we're looking for then therefore overall is for the prices to increase and hopefully get a strong close today. Strong closes today mean that the mean will start off higher up on the next day, and then the reversion to that mean should then hopefully be overall ascending up the way, which is why you see this pattern here with regards to the mean, the price is gapped up, the mean, the price is gapped up, the mean, the price is gapped up, and that's what's going on over here. Final note, I suppose, since I'm so, you know, explained so much to people, when you're looking to work out what divergence is, and people ask me this all the time, for instance, even in this very live stream, I had a conversation with somebody, what's the difference between the stochastics and the RSI? Well, whatever, people always ask these things, and I want to explain, you know, in terms of maths, how these things are calculated, and a lot of people don't really understand it, and you can look through the book and you know, that J. Wells Wilder Jr. wrote, fantastic, wonderful book, recommended read it for absolutely everybody out there, but he was a mathematician, so wouldn't surprise me if you hated it. Just kidding. But the way that he works out divergence and the way that, you know, the overall the calculation for it, we know already that in this period of time where the prices were going up here that they were bearishly divergent, right? And you don't need to understand this concept right now if you're new to it. It's fine, just let the information flow over you. You'll become more familiar with general concepts, and as a result, when you actually do dig down into the information in the future, you'll find it easier to understand. For those of you who do understand what I'm saying and already know about divergence, you might be wondering how the maths of it's worked out, but also somewhat daunted by me flinging up a bunch of numbers on the screen. And like I already said, no worries on that front. I hate maths. There's no way that I would explain to you a mathematical concept actually using maths. That's not the way that I work. It's not the way my brain works. It's not the way I think about things. And it's one of the reasons why I'm quite good at maths as well. It's because I don't look at it that way. Divergence. What is divergence? Well, I can visually represent it to you by showing you the difference between these triangles here. You can see this is a fairly acute triangle. Let me just draw in another triangle here for us. And you can see that this is, while it's still fairly acute, is not as acute as the previous one. Let me just draw in another triangle for us here. And you can see, again, that same sort of construct. And then let's assume that the prices were to get up towards that point just there and draw that on. Now you can see these diminishing triangles just here, can't you? I'm sure you can see them. And you can see that the difference between the lows and the highs relative to the difference between the previous high and the subsequent high are, of course, diminishing throughout. So essentially what you've got here is a series of angles towards the top side. So I can just show you that by drawing over the lower side angles, and I can show you that's angle number 1. Then I can show you what angle number 2 is, and you can see here it's less steep. Then I can show you angle number 3, and of course it's going to be less steep again. So this is mathematics, by the way. This is just visual mathematics. This is the way Stephen Hawking does maths, if you're interested. He's still alive, right? Isn't he? I don't know. Anyway, and then you can see here that if we did go up towards the top end, there's a chance that we could throw off the bearish divergence that we had previously. Okay, there's a chance that we could throw off the bearish divergence that we've had previously, right? If we got towards the top end here, because I've measured this in using the angles as the previous high as the body closes. You'll see this is on the body, right? You'll see this on the body, okay? So this is our RSI divergence. An RSI divergence would be overcome with a nice solid move up towards the top end into this box here before cracking on up the way. That's RSI divergence. Somebody wanted to know what the difference is. Oh, thank you so much. A cup of tea. Excellent. Tea time with Rocky. No tea, that's fine. Have coffee. Tea time with Rocky. No tea, that's fine. Have coffee. So you want to know what the difference is then mathematics-wise between the RSI and the stochastics. Now, obviously, I could have explained this using numbers, but screw that. Like I say, I hate maths. But you'll be looking at the difference between, you know, the actual peak price and the lows that we're having in terms of stochastics. Peak price and the lows, and then again as well with the peak prices and the lows, and then making a comparison between the angles that we've got here. And as you can quite simply see as well, that without even starting off the way, that the second peaks aren't even taking out the higher peaks, and as soon as you're going below 45 degrees, well, obviously you're in a negative stance in that sense, so you'll be expecting to see at the very least some divergence if overall price action continues to be positive towards the top side, etc, etc, etc. And these are the sorts of differences then that you can, this is the different ways of visualizing the difference between a couple of different oscillators and how they work and what calculations they're taking on board. So understanding the visual aspect of these things, I think, is a very, very fast route towards understanding the complexities of the mathematics without having to actually go in there and try and, you know, become a godforsaken mathematician. Right, nice one, excellent. Isn't it nice to have that there little bit of information? Anyhow, that's going to have to be pretty much all from me, folks. See you next time.